Hey everyone, this is Ryan Mallory with Share Planner. It's been a crazy week of trading, going back to last Monday where the S&P 500 actually closed at 2102, and now we find ourselves at 1893. So this time last Monday we were trading at a 2% gain for the year. And it was looking like we were starting to break out and we were going to challenge those new all-time highs. And then all of a sudden, 5 days later, where do we find ourselves? We're trading at 1893 and down, instead of up 2% for the year, we're down 8.1% for the year. And I mean, that's mind-blowing. I mean, this is like literally one of the biggest drops, particularly the last 3 days, one of the biggest 3-day drops that this market's ever seen. So this is an event that's taken place here that we're going to be talking about for years to come, similar to like what we talked about in 2010 with the May flash crash, and back in 2008 when we talk about the Great Recession. If this selling persists, we're going to be talking about this period in the stock market for a long time. But what's interesting is that, you know, when the market's going good, I don't get a lot of feedback from people. You don't hear a lot from people, you know, about, you know, their fears in regards to their portfolios, to their retirement accounts, or anything else. Everybody's pretty ho-hum and it's going along, but you get 3 days of massive selling, and panic really does set in, and you see it a lot among friends and family and everything else. So I'm doing this video tonight, and I really don't ever do these things. In fact, I had to go onto YouTube and figure out how to do one of these video recordings here. So, you know, pardon the awkwardness because I'm not all that comfortable being in front of the camera, but nonetheless, I feel like this is a good opportunity to talk about my understandings of the market. I'm not trying to give you personal advice here or anything else, but this is what's really helped me out over the years to get through the ebbs and flows of the market, and to be able to, number one, preserve capital, and then two, to add to it, you know, on a year-to-year basis. So really what people want to do when it comes to the stock market is not have to pay attention to it, particularly with their 401ks, their 403s, their RAs, and everything else. They really don't want to have to pay too much attention to it. It becomes a problem when they do, because usually when they start paying attention to it, it's because the market's just dropping like crazy. So there's a lot of fear and concern and worry, and frankly, most people don't pay that much attention to the market. So when they see it drop like it has, well over 1,000 points in the past few days, where the S&P is down 8.1% for the year, there's a lot of concern. We're in correction mode from the all-time highs. I mean, the S&P from its recent highs has corrected over 10%. So has the Nasdaq. So has the Dow. So there's a lot of concern, and the problem is a lot of people really don't know what the market's going to do next, because they don't really immerse themselves into the stock market. So it's really a crapshoot for what they should do next. So what happens is the market sells off and sells off and sells off until people can't take it anymore, and they sell out of their positions. Okay, and then what these people always see is the market rally without them. All of a sudden, they'll get out of it almost as soon as they get out of the market. When they've reached their max pain, where I can't afford to lose any more money, they get out, the market rallies. Okay, and I see it usually the height of the pinnacle of concern among friends and family and you know, colleagues of mine that I trade with. When it starts to reach that, you know, that fever pitch of concern and panic, that's usually when the market bottom is in. And so the big thing, the best advice I could convey to you in this video is to manage the risk. Okay, manage the risk at all costs, and that doesn't mean waiting for the risk to come about. Okay, not waiting for the market to go ahead and sell off 10% before you start being, you know, concerned with the risk in your portfolio and your IRAs. Because here's the thing, we, you know, particularly like my generation and younger, we've seen our parents, you know, they steadily put money into their retirement accounts and everything else, and they saw their money grow, and some of them are sitting on well over 7 figures in their retirement accounts, because through the 80s and the 90s, they just saw just an unprecedented growth. But the thing is that's not the kind of markets that we have anymore. Okay, we have a very central bank governed market where the actions of the market are predicated by what the the Federal Reserve is doing. What is Janet Yellen doing? Before her, what was Ben Bernanke doing? And that was really what guides the market, and it's still the case today, even more so than ever before. And now you have a much more global economy to where, you know, the problems in China now are directly affecting what's going on here. We have a massive sell-off in oil, and that's causing the markets to sell too. I mean, everybody likes cheap gas at the pump, but nobody likes how it affects the stock market and what it does to companies as a result. So here's the thing. It's not like your parents' stock market anymore, okay? It's not you just keep faithfully stashing away money into it and it's going to build up into a nice retirement egg, okay? Because, you know, since 2000, when the bubble burst in the NASDAQ, or the dot-com bubble burst, you know, you've had a recession there. Then you had the Great Recession in 2008. You had a massive sell-off in 2011. Not like 2008, but one that was driven by the collapse of some of the countries in the European Union, namely Greece, and they're still in the news today, obviously. And then you have today where we're just selling off more than what we've seen in years since 2011. So it's like the market takes, it's what a lot of people will say, the market takes the stairs up and it takes the elevator down. And we've seen that better than ever in these past few days. So you have to manage money. You can't just ignore it. You have to look at it. So, like I have I have a retirement account. So how do I manage that? Well, you know, a few months ago, the market had been stuck in this range, and it had been stuck until last Monday in this range where it just wasn't breaking out. From February onward, it was stuck in a very tight range. In fact, the tightest range that the market's ever seen. I mean, it was like 6% range. I mean, really the only other time that the market's ever seen anything like that was 1911. So this isn't something that was very common. So I say to myself, okay, I can go ahead and stay in this market that's not going anywhere but sideways, and I have three things that can happen. Okay? One, we break out, which would be the best case scenario, to the upside, establish new all-time highs, create a new trend, a new leg higher. B, we stay in sideways, I don't make any money. Or C, we go straight down and I lose money. So there was two out of those three options that I didn't like at all. So I went ahead and, you know, rebalanced the portfolio to where it's out of the equities and into the bonds and everything else. But I had to be proactive about that. I had to look at the options that the market was giving us at the time and say, you know what, from a long-term retirement account, something that you know I'm not going to be able to do anything with until I'm much older. I need to be much more careful. I need to manage it day to day, okay? And that doesn't mean I need to get in and out all the time, but I need to be cognizant of what the market's doing all the time. And when I see these different options that come about, I said, well, I need to go ahead and reshuffle, get into bonds, you know, money market accounts, and then if the market does break out to the upside, then I'll start scaling back into the market each week. You know, add a few percent here, add a few percent more from cash and bonds into equities, and just do that on a consistent basis. But you know, if the market's going to go sideways, why be, you know, stuck in equities where there's more risk? Why be? And if the market breaks down, I definitely don't want to be in it then. So I've been out of the market with my retirement accounts for a long time now. I'm really an active trader, and as an active trader, I want to trade as much as I can day to day, and I call that a swing trader. So that's really my niche. But I still, as a person who has a retirement account and everything else, I don't want that money to just, you know, take a beating for no reason at all. So I could look at the charts, and I was able to see those three options playing out. I decided, okay, if I get out, I'm going to already know where I will get back in at. And that's the thing. A lot of people, they will get out of their 401ks and their retirement accounts, but they have no plan to get back into their retirement accounts. And that's a big problem, because they get out and then they watch this market rally without them, because they never had a plan for when they were going to get back into the market. So if you're going to get out of the market, you better be darn sure that you have a very clear-cut area that tells you this is where I'm going to get back in at. You have to plan your trades. You have to plan your actions, and you just can't do things out of fear and greed. These are two very strong emotions that can completely rob you of thousands and thousands and thousands of dollars long term if you let them control you. So be smart about this market, okay? And here's the thing: going forward, do we go up or down? Is it a time to buy? I don't know. These are questions that I'm definitely being asked. To be honest with you, I don't know. I don't know if we go up tomorrow. Right now, the futures are pointing at an open higher, but we could open up and then we could sell right off again. So, you know, what the market's doing right now, who knows? I mean, European markets have yet to open, so it could easily go back down. The thing is, it's not about predicting stocks. That's not how you succeed at the stock market. You succeed at the stock market by managing the risk. Okay, it's like being dealt a hand of cards. Okay, in poker, if you don't have a good hand, you fold. Okay, and it's the same way with the stock market here. If the risk isn't in your favor, you don't stay in the market. If the risk is in your favor, you do stay in the market. You increase your exposure to the market. But when the odds are against you, you don't try to beat the odds, okay? A lot of people like to be the hero in the stock market. Really, the stock market is about being a coward, because if it's not going to go well for you, run. Get out of the market, okay? If it's going to go well for you, take advantage of it. Do as well as you can. But you got to manage the risk. Everybody thinks it's about the stock picks. Everybody thinks it's about finding that magical stock that's going to make them 100 or 200%. It's not about that. It really has nothing to do with about that. It's about making consistent profits, managing your profits, and managing, most importantly, the risk that's associated with every action that you take in the stock market. When I take a trade, I know exactly where I'm going to go out if the trade goes against me, every single time. I am not going to let one trade destroy my portfolio, and I always trade with the frame of mind that what we have seen the last 3-4 days in the stock market could happen again, okay? That it could happen tomorrow, that it could happen today. But I've traded through these horrible markets many times, and I've seen it enough times to where I always act like that the next minute in the market could be what triggers the next sell-off. So always manage the risk. Always manage the risk. It's not about the stocks. It's not about, you know, getting these magical stock picks that will make your wildest fantasies come true. It's about the risk. And when it comes to your retirement, it's about managing the risk. You can't just push it aside and just hope that it's going to grow over time. That's as much as that was the case for the older generations. It's not the case now. You have to be active and manage it. You have to look at the charts. You have to take the time to follow the stock market, or really you shouldn't be in the stock market at all. And so, with that said, I'll wrap this up. But I hope you guys have a good understanding of what I mean by being wise stewards of your retirement accounts, of being wise stewards of your trading accounts, managing the capital, managing the risk, and not getting beaten up from this market unnecessarily. So with that, I'll leave it there, and y'all take care. You know, I hope for the best for you guys in the days ahead, and God bless.